Welcome to Iron Financial. This is where we help you forge a stronger portfolio by cutting right through the market's weakness. Today, we are putting Phoenix Education, that's ticker PXED, directly under the microscope. Now, you probably saw the headline. The stock absolutely surged, jumping more than 8% after hours, right after their Q2 earnings report dropped. And look, on the surface, that looks like a clear, undeniable win. But that's not what we do here. We're here to run a full financial stress test. We're going to determine if this rally is built on a solid foundation of steel, or if it's just a pretty facade hiding some really critical weaknesses. So, let's get into it.
All right, so first things first. Let's look at the exact number that caused all this commotion, the headline grabber. Wall Street analysts, they had their models, they punched in all the numbers, and they came out expecting about 42 cents in adjusted earnings per share. Pretty standard. But Phoenix Education, they came out and delivered 58 cents. Do the math on that. That is a massive 38% beat. It's not just a beat, it's an absolute knockout punch. And the market's reaction was immediate and brutal for the short sellers. A huge wave of buying just flooded in. When you see a number that strong, that decisive, you have to ask yourself, okay, what's there to even stress test? This looks like an open and shut case, a screaming buy. But here at Iron Financial, we know better. The headline, well, it's never the whole story.
And that brings us to the market's reaction, an 8.2% surge after the bell. That shows a huge, powerful wave of buying pressure. But honestly, that's precisely why we have to do this deep dive. At Iron Financial, we know from experience that the biggest, most costly mistakes in the market happen when investors react emotionally to a single data point without checking the structural integrity of the entire company behind it. That initial pop of enthusiasm, that's what we're putting to the test today. Is this newfound strength real? Is it durable? Or is it just a bit of surface-level hype that's going to crumble under the slightest bit of pressure? That's the question we need to answer. So, to figure that out, we've laid out a 5-part blueprint for our investigation today. Think of it as our plan to inspect this building from the foundation to the roof. First, we're going to examine that after-hours anomaly. Second, we are drilling deep into the numbers, and we're going to separate the steel beams from the hairline cracks. Third, we're going to inspect what we're calling the fortress balance sheet. Fourth, we'll decode management's own blueprint for the future. And finally, of course, we will deliver the official Iron Financial verdict.
Okay, Section 1, the after-hours anomaly. Now, the market's reaction seems so simple, right? A company crushes its earnings estimate and the stock takes off like a rocket. It's the oldest story in the book. But our job is to look past that beautiful, attractive facade, because that's exactly where the most dangerous, most expensive investment traps are usually hidden. We need to understand why the market fell in love so fast.
Let's move on to Section 2, drilling into the numbers. Now, this is where we do the real heavy lifting. We're going to put this entire financial report on the anvil and hammer on it a bit to see what's truly solid and what's brittle. In any structure, you've got these massive load-bearing steel beams holding everything up. But you might also have these hidden dangerous hairline cracks that threaten the whole thing. Our job is to find both.
Let's start with those steel beams, the undeniable positives, the things that drove that 8% rally. Of course, the 38% adjusted EPS beat is the main headline. But when you look underneath that, you see adjusted EBITDA, and that's a key measure of a company's real operational profitability growing at a very healthy 7.8%. And maybe most importantly for an education company like this, average degreed enrollment is up 1.8%. I mean, that's the lifeblood of the business. More students means a healthier business, plain and simple. These are the solid, powerful operational metrics that are holding the entire bull case up.
But here's where we find the first little sign of rust. The top-line revenue, the total sales. A year ago, in this same quarter, it was $223.4 million. This quarter, it's $222.5 million. It actually went down. Okay, it's not a huge drop, it's essentially flat, but it is negative. You have to ask yourself, shouldn't a thriving structure be getting bigger, not stagnating, or even worse, shrinking? To me, this doesn't feel like a steel beam supporting the company's weight. It feels more like a potential point of weakness we need to watch.
And that brings us to the first major hairline crack we found. And folks, this is a big one. This right here, this illustrates the huge disconnect in this earnings report. So forget the flat revenue for just a second and look at the GAAP net income. This is the official, by-the-book, SEC-audited bottom-line profit. A year ago, it was a respectable $16.1 million. This quarter, a mere $10.8 million. That is a jaw-dropping fall of almost 33%. So the big question is, how on earth does a company report a 38% beat on their adjusted earnings when its official profit literally fell off a cliff?
Well, we don't have to guess. We don't have to speculate. The company tells us exactly what happened, right in their own earnings call. Here's a direct quote from the CFO, Blair Westblom. The decrease in net income was primarily driven by higher share-based compensation expense associated with our IPO. It doesn't get any clearer than that. They are literally pointing a giant flashing arrow at the exact line item on their financial statements that created this massive, confusing gap between the number the market absolutely loved and the number that, frankly, looks terrible.
So let's break this down. What exactly is share-based compensation? You hear this term all the time. Simply put, it's a non-cash expense. So it's not like money is physically leaving their bank account to pay for this. It's the accounting value of all the stock options and awards that are granted to executives and employees. But, and this is absolutely critical, it is a very real cost to you, the shareholder, because it dilutes your ownership. Think about it. Every new share granted to an employee makes your existing shares a slightly smaller piece of the whole pie. And this expense, it almost always spikes dramatically right after a company has its IPO and goes public, which is exactly what PXED did in late 2025.
And we really need to be crystal clear about the scale of this thing. This is not some small, trivial accounting adjustment. In just the first 6 months of this fiscal year, this single non-cash expense, share-based compensation, totaled a staggering $39.2 million. That is a massive number that is being subtracted from their earnings. This expense, it's the entire bridge that explains the huge chasm between that ugly GAAP net income number and the beautiful adjusted EPS number that the market completely fell in love with.
So the picture of the income statement is, well, it's incredibly messy, right? You've got flat revenue on the top line and a GAAP profit number that's falling off a cliff, and it's all being hidden behind this huge non-cash adjustment. So why would any sophisticated investor, why would Wall Street ignore all of that? Well, the answer is they're looking right past the messy income statement and staring directly at the foundation. That brings us to Section 3, the Fortress Balance Sheet. And in the case of Phoenix Education, it's not just a balance sheet, it truly is a fortress.
Let's look at the first pillar of this financial fortress. It's the cash pile. They are sitting on over $250 million in cash, cash equivalents, and marketable securities. That's $252.1 million. Now, this isn't just a rainy day fund. This is a war chest. It gives them immense flexibility to invest in the business, to acquire a competitor, to survive any economic downturn, or, as we're about to see, to return that capital directly to shareholders.
But this is what's even more impressive. I'd argue this is the single most important number in the entire report. 0. A big, fat 0. That is the amount of outstanding debt on their books. They have no leverage. They owe nothing to nobody. Now think about that for a second. In an economy with volatile, unpredictable interest rates, this is the ultimate sign of financial durability. No creditors can come knocking on their door demanding payment. No rising interest payments can suddenly squeeze their profits out of nowhere. This company, for all practical purposes, cannot be broken by debt. And for the bulls, this is the bedrock of the entire investment case.
So a fortress is impressive, but you have to ask, what is the company actually doing with all this incredible financial strength? How does this benefit you, the shareholder? Well, management gave a very clear two-part answer in this report. First, the board authorized a new $50 million share repurchase program. That means they are actively going into the market and buying back their own stock, which makes every single remaining share more valuable. Second, they confirmed their regular quarterly dividend of 21 cents per share. This is a direct cash payment into investors' brokerage accounts, and it's proof that they're not just hoarding cash, they're actively, consistently rewarding their shareholders.
Okay, so we have this company with a real split personality, don't we? A messy, confusing income statement on one hand and a rock-solid, impenetrable fortress on the other. And the market, at least in the after hours, is clearly betting on the fortress. But what is the management team, the actual architects who built this company? What do they think is going to happen next? That brings us to our fourth section, decoding management's blueprint.
Now, this table tells a story that every single investor needs to see. On the left, you have the full-year revenue guidance coming directly from the company's own leadership. They expect to bring in somewhere between $1.025 and $1.035 billion. But look over on the right. Before this report came out, the Wall Street analyst consensus was for $1.052 billion. You see that? There is a clear and a pretty significant gap here. Management is telling the entire world to lower its expectations.
Let me put this bluntly. This is a massive red flag. You have the market, in a state of euphoria, pushing the stock up over 8% in a frenzy. But the people who actually run the company, the insiders who know it best, are putting out official guidance that is basically telling everyone, whoa, slow down, you're getting way too optimistic here. That is a direct contradiction between the market's action and management's communication, and that is a conflict that you simply cannot ignore as a serious investor. All right, we've done the work. We've seen the hairline cracks in the income statement, we've inspected the steel beams in the Fortress balance sheet, and we have read the cautious, perhaps worrying, blueprint from management. It's time for Section 5, the final verdict. After running this company through our financial stress test, is PXED a solid opportunity built on bedrock, or is it a structural trap that's just waiting to collapse?
So here is our final analysis from Iron Financial. The market on that day made a very specific, very calculated decision. It chose to look at that $39 million share-based compensation charge and completely dismiss it. They labeled it as temporary, non-cash accounting noise that's just a byproduct of their recent IPO. In the market's eyes, it's not a fundamental operational flaw. Instead, the market focused all of its attention, all of its capital on the Fortress. That zero debt and the $250 million in cash create a massive margin of safety that you just don't see very often. They saw the buyback and the dividend as concrete proof that management is on their side. So the market's bet is simple. They are choosing long-term financial durability over short-term revenue flatness. They see a structure that cannot be knocked down, even if its growth has stalled out for now.
And really, this all brings us to the final question that you, as an investor, have to answer for yourself. Is the market right? Is Phoenix Education a company with a foundation so solid, so unbreakable, that you can afford to overlook stagnant revenue and some really messy accounting in the short term? Or is a company that isn't growing its top line ultimately just a house of cards, no matter how much cash it has in the bank today? That is the stress test. Thank you for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.